We're calling the session Are Trade Wars Class Wars? And our first guest will be Matthew Klein, an economics commentator for Barron's and an author of a book that is just like the session title we have, but without the question mark. He and Michael Pettis recently published Trade Wars Are Class Wars: How Rising Inequality Distorts the Global Economy and Threatens International Peace. He'll be joined by Kathy Feingold, Director of the International Department at the AFL-CIO and Deputy President of the International Trade Union Confederation. Welcome to you both. We will be hearing from our two guests and then have plenty of time for Q&A. If you have a question, raise your Zoom hand, the little green button on the bottom of your screen, and we'll give the microphone to you. You can also put a question into the Q&A text function, and please tweet today at #NPFTrade. So Matt and Kathy, thank you very much for joining us. We're excited to have this conversation. It's kind of a big concept discussion. You know, we love to get people talking and thinking about trade, and this is kind of a discussion of the broad trends of trade and how it's affecting the working class. So we will go to Matthew first. So Matthew, welcome, and looking forward to hearing from you and hearing about your book, which we have right here, and I'm sure you can buy at your favorite online retailer. So Matthew, welcome, and looking forward to hearing from you.
Thank you very much, Chris. Thank you for having me. So I'm just going to do a quick sort of summary talk of the main arguments of the book, and then hopefully that'll lead to a worthwhile discussion. So, as we said, the book is that we put the thesis in the title that trade wars are class wars. And the reason we frame it this way is that it's very easy to think of economic conflicts as being between countries, that it's either about sort of geopolitics or incompatible national interests or differences in cultural characteristics. And our argument is that that's not right, that it's actually much more useful to think of the global economy as a single system that's connected through trade and finance, and that issues in one part of the world will affect people in other part of the world through those channels. And it's very easy to misinterpret that as country versus country when it's really economic class versus economic class. So, there are sort of two common wrong views that are very common when it comes to trade that we've seen both, especially in the past few years. One is sort of just a caricature that names a little bit, people who say everything was just fine, that, trade doesn't actually affect domestic conditions one way or the other. You can call these globalists or what have you, that, it's not appropriate to think about trade as being either as ever causing problems. And then the other sort of opposite extreme view is that everything that's a problem is because of foreigners, and that, that foreign governments are taking advantage of people at home, and that's the issue. And our view is a little more subtle and actually goes back over 100 years to a British economist named John Hobson. And I'm not going to read this quote, but the argument that he made at the time was essentially that the conflicts, what it looks like conflicts between countries are really a function of the fact that the very rich, they have, when they have too much income, relatively speaking, or too much of a share of national income, that distorts the way the economy works, and that leads to pressures to create trade conflicts with the rest of the world. And in his view at the time, this was one of the explanations for European imperialism in the late 19th and early 20th centuries. And then subsequent thinkers, most recently Kenneth Austin, who used to be at the US Treasury, have applied this to understanding the modern period of basically, the 2010s and the 2000s, and with different sets of countries involved. And so, to understand this argument, because it's not necessarily very intuitive, it took me a long time to understand it. And, my co-author was Michael Pettis, is very helpful. Why does inequality actually matter? And there are a lot of reasons why people might think inequality matters, and other people have written about this, whether it's, questions of fairness and incentives and so forth. And I'm not going to talk about that, but there's a very simple argument why it matters, which is that people and economic entities that are very, very rich or very high income, they behave very differently from everyone else. So most people over the course of their lives will spend essentially everything they earn on goods and services. And when you spend on goods and services, you end up creating income for someone else. So all income comes from someone else's spending. All spending is ultimately coming out of income or change in debt. And so the difference is that people who are very rich, and you can see this on the chart on the right here, they save something close to half their income. And the reason, of course, is that there's only so much you can spend on goods and services. You might be incredibly, have very, very lavish taste, but at the end of the day, you can only have so many, $1 million birthday parties per year. The rest of it, you're going to be, buying assets, whether it's financial assets or real estate. And the flip side of this is that if you're buying those assets, someone else has to be selling those assets. And so what in general this means is that shifts in the distribution of income lead to shifts in borrowing and debt. And so a lot of economists have found this over the years in different places and in different times. But if we think about globally, the problem that's occurred over the past sort of 3 or 4 decades is a sharp change in the distribution of income. That was been made possible. It was necessarily coincident with a big increase in debt. And so, the chart on the right is just showing it for the United States, but you can see this. There are a lot of academic papers showing this for other countries as well, and you can see it in the 1920s as well. So this is a well understood phenomenon that when the top income share rises rapidly, that you're going to have that offset somewhere else, because they wouldn't, how would they keep earning money? How would corporations keep generating profits without sales? And the reason is that people who are losing out are making up for their lack of income through borrowing. And you can see that in the chart on the left. Okay, so now let's look at some specific countries to some concrete examples here. And so in the book, we talk really about we talk about a lot of countries, but we focus really on 3 in particular, because they're sort of the major global economies. And between them, they're representative of a lot of what we've seen elsewhere. And the first one is China. And, there's a lot of stories about what's happened in China, and there's a lot of nuances we can take. But I think one thing that's really important to understand is that basically after 1989, the Chinese economy underwent a significant shift, that the political economy was such that regular Chinese households and workers ended up losing out pretty dramatically to, we call them elites, but you can think of them as whether they're provincial officials or people connected with state-owned enterprises, or rich people who end up being affiliating with the Communist Party, and also the owners of multinational companies that set up operations in China. And so one way to see this is on the chart on the left, which essentially is showing, okay, of all the value that the Chinese economy is producing, the workers, the businesses, the machines, and so forth, how much is going to households who are actually buying things that make them happy? That's the blue line. And then how much is going to either business investment or net exports? And net exports essentially is you can think of that as what they're giving to the rest of the world in exchange for some kind of financial claim. And what you can see very clearly is there's a big shift starting in 1989, where households are earning progressively smaller shares of China's national income, and it's instead being redirected elsewhere. Now, Chinese households, if you were to ask them, which we can't, they probably would say that this is not necessarily a problem because their overall levels of income are rising so rapidly, but it's nevertheless the case that if China's overall production is growing at, say, 10% a year, and household spending is growing at 6% a year, you can see that. I mean, that would lead to a big difference. And this is particularly important more recently as China's overall growth has slowed down, that China's household consumption has also slowed down with it. So even though China's, you see a little bit of a increase in the blue line starting around 2010, it's still extraordinarily low. I mean, so for some context here, for a large economy, that's basically unprecedented. I think the only time you can see in a sort of a large diversified economy where household consumption is that low as a share of a domestic production is basically Stalin and the Soviet Union, when you had people starving to death so they could generate grain exports to fund industrialization and trade with the Nazis. Now, China's situation is better than that in terms of household living standards, but it's still an extreme kind of situation. And if you look at other countries in the world that have that, it's basically either corporate tax havens where the numbers are sort of not really reliable, or oil sheikdoms when the oil price is high. And again, that's not really representative of the Chinese situation. And so what's the consequence of this? The consequence is that if workers aren't being paid well enough, which is the key point here, then you're going to have a situation where companies are generating a lot more stuff than people can absorb domestically, and that excess has to be sold somewhere else, and that's where we get the trade conflict from. So, if globally, the problem is that more stuff is being produced than is being able to be absorbed domestically or being absorbed by people in the world as a whole. The difference comes from borrowing, but those specific imbalances are different in different countries. So some countries might have the inequality, some countries might have the debt, some countries might have the excess production. That shows up through trade. That's where these conflicts come from. So in China, what you had basically before 2008 was there was no real meaningful increase in debt within China, but there was debt in the rest of the world, China's trade partners. Since 2008, China has also increased its indebtedness, but nevertheless, you still have a situation where China is just producing more and more excess sent to the rest of the world because Chinese households aren't consuming. So that's a situation in China. A very different set of situation in Germany, but nevertheless,
Matthew,
the end result is kind of
yeah. Sorry to interrupt, but I just had a question. somebody
Of course.
posed to me, if you could go back to the China one.
Mhm.
There's basically two periods in which the red line goes up and the blue line is correspondingly drops. One looks to be around the 2000s and one's in 1990. I mean, what
Yep.
are there similarities? What's going on at those two time periods? Are there similarities? What are the broad changes underway at that time?
So that's a great question, and we talk about this in more detail in the book. But essentially, if you after 1978, when China abandons sort of the Maoist way of operating, and there's a significant amount of liberalization in the countryside, you have rapid increase in productivity growth, and that's leading to rapid increase in living standards. But the unevenness of the liberalization between the countryside and the cities is such that you end up, by the end of the 1980s, you have these rapid increase in food prices, and that coincides with rising demands, popular demands for more democratic governance. The regime, cracks down quite violently in 1989. You have essentially a rollback of political liberalization and the adoption of essentially a different kind of political economy that's much more state-directed, much more heavy-handed, and that coincides with the shift in the early 1990s. And then in the 2000s, you have, for slightly different reasons, but kind of similar, which is that you have this big increase in debt in the 1990s in the Chinese banking system. And the way the government chooses to deal with that is basically they bail out the banks by essentially harming household savers. So at the time, you really didn't have, if you were a Chinese person, the only way you can save money is by putting a bank deposits in the bank. And if the interest rates on those deposits are just extraordinarily low relative to the returns that you ought to be earning from the real economy, and then the banks make loans to companies at low rates but higher than the deposit rates, and the banks will get bailed out, and companies will get basically cheap funding. So it's effectively, that's a way, and my co-author Michael is Michael Pettis is really the China expert here, and he's calculated that process in sort of the first half of the 2000s, it was equivalent to basically a tax and transfer from ordinary households to big companies on the order of sort of 3 to 5% of Chinese GDP every year. So it's very, very large. That stopped around sort of 2010, 2012. And you can see that sort of coincides with the end of the bottoming out of the blue line, but it wasn't enough by itself to really reverse kind of the accumulation, because there are a lot of other things. Labor rights in China, basically, adversarial labor unions in China are illegal. You have a situation where a large proportion of the urban workforce are because of the way that China's household registration system works, which is sort of a relic of the Maoist era. People are treated essentially as illegal immigrants. They're not able to qualify for things like housing benefits or healthcare or education, even though they pay the taxes for it when they're in the cities, and they can theoretically be deported at any time. You have situations where land is essentially can be confiscated more or less at will by local governments to give to businesses. So there are a lot of these factors that contribute to the suppression of household incomes, and that in turn lead to lower household consumption. And the extent that the Chinese government hasn't addressed most of those problems, despite having said that they recognize that these are issues, that explains why household consumption is so low and why it's such an outlier compared to the rest of the world.
Okay, got it. Thanks.
And just to be clear, while it's very easy to associate these kinds of developments with undemocratic regimes, you can also have these kind of problems in democracies. And so that's why the German and sort of broader European example is very interesting. And so Germany, I think, is really fascinating because the sort of common story you hear about Germany is that the reason that Germany has a trade surplus is that German exports are just very competitive, they're very high quality. And that just does not make sense. I mean, they are. I mean, I have no problem with that. I mean, I have a Miele vacuum, and it's wonderful, but that's not really why trade surpluses arise, right? Trade surplus is the difference between exports and imports. If you're good at making exports that people want, the reward for that should be higher living standards at home because you can buy more things. But that's the opposite of what's actually happened. The reason why Germany has a trade surplus is because their import growth has slowed very dramatically since about 2000. The other way we can think about this is that if you look at it, and I don't have this chart here, but if you look at a longer history of Germany's trade balance, basically since the end of World War II, it was basically flat. It was either a small surplus or flat through that entire period, or actually slightly in deficit in the 1990s. And then recently, basically since 2000, you have this massive sustained trade surplus. And so is that a function of German cultural characteristics? Probably not. Did anything change meaningfully? I don't think so. Is that a function of, did the quality suddenly improve? No. In fact, if you look at just the growth rates of German exports, the growth rate of German exports since 2000 is much slower in the period when the trade surplus was rising than it was in the 1990s when there was no trade surplus. The difference came from imports. And you can see this in the chart on the left very clearly, which essentially is that German domestic, in the early 2000s, you had a very severe recession in Germany as a consequence of the tech bust and a consequence of other things. And imports fell as a consequence because imports basically tracked, domestic consumption, household consumption and business investment. German companies that exported, their growth was still relatively weak because there was a global recession, but nevertheless, their sort of exports just rose in line with overall, demand in the rest of the world, and that opened up a big gap between, the blue and the pink lines there. And one way of thinking about the same thing is that German companies responded to the recession that they had, or alternatively, you could say they created the recession, but they cut business investment at home. They cut worker pay, both by laying people off and by reducing hourly pay and essentially shifting the balance between capital and labor. And nevertheless, they were able to maintain their sales because people in the rest of the world were still buying their stuff. And so, the German corporate strategy would not have worked if everyone in the world had tried it at the same time. It worked because people in the rest of the world were willing to borrow to buy German goods. And so, one way of looking at this is the chart on the right in terms of who's benefiting from Germany's trade surplus, which is that if you look at the change in the trade balance since the early 2000s and the change in the technical term, the net operating surplus of German businesses, they match quite closely. So essentially all the gains went to German companies that either they were using to pay down their debt or retain earnings for their shareholders. Often these family-owned businesses, which is a quirk of the German system, they don't have to pay inheritance tax if you pass down a family-owned business. It's a very strange system. So obviously, you have a lot of rich people creating, holding family-owned businesses and then keeping money within the family-owned business to avoid paying taxes and passing money on down to their heirs. So this is a situation that's clearly not good for Germany, people in Germany, and it also has consequences of the rest of the world. Now, this ended up spreading to Europe over time. So before sort of 2010 or so, the bulk of Germany's excess production, or alternatively their underconsumption, was offset by behavior in the rest of Europe. And so you see that for Europe as a whole, household consumption and total production of businesses basically matched pretty closely until about 2010, which makes sense. The reason we have an economy, broadly speaking, is to sustain household consumption. Like that's the point. We want to be able to improve our own living standards. If you're producing things that you aren't consuming, then there's a problem. You see that breaks down starting around 2010. And the way to think about why that happens, you can see in the chart on the right, which is that Germans sort of the underconsumption, or alternatively the spending too little relative to how much they are producing, that's sort of the dark blue column. That was offset by sort of the opposite development you see in places like Spain, Italy, and Ireland, and Portugal, and the Baltics, places where you had very large increases in debt, mostly household debt, before the crisis. And so the result was that Europe as a whole looked like it was in balance. The problem is that then you have the euro crisis, and suddenly for a variety of reasons, the ability of those countries to access borrowing markets was cut off. And so rather than having a situation where Germany and then the Netherlands, which had some similar behaviors, essentially spent more to offset the decline in spending in Spain and Greece and Italy and so forth, you didn't have that. It was a very asymmetrical adjustment. So you just had this massive decline in spending in the crisis countries, and that led to a big shift overall in Europe's position. So you can see the big gap in the chart on the left opening up between production and consumption, and that's where you end up with Europe with a very large trade surplus. And so you can see there's the change in Europe's trade balance since about 2010 or so is purely a function of the fact that spending, both household consumption and in business investment and public infrastructure investment, and public service provision in the Euro crisis countries just collapsed and has basically stayed down. The idea that there was an increase in competitiveness, which you sometimes hear if you talk to Europeans, is just not true. It's true that Portugal has managed to do relatively well in boosting their tourism exports, but other than that, the reason why you've seen this massive change is purely a function of depressed domestic spending. And so again, you see a situation where large swaths of people have become poorer than they otherwise should have been. In fact, inequality has increased quite dramatically in a lot of these countries. The social safety net has been shredded in a lot of these countries, which is something you also saw in Germany in the early 2000s. So they're all worse off. And the rest of the world is worse off too, because suddenly you're in a situation where there's less spending in Europe, and so that has to be offset somewhere else. And so that leads me to the sort of the last section here, which is looking at the United States. And the United States is not unique; it's the biggest country that faces the situation. But it's really actually, if you look at sort of all the sort of English-speaking advanced economies, Canada, Australia, the UK, you see broadly similar patterns. And there's a reason for that, which is that the financial systems in these countries are very accommodative of this, and legal systems. But essentially what you see is that the underspending in the rest of the world is offset by either rising debt in the Anglosphere, or alternatively by lower production, both of which are harmful. So we can sort of talk about which is more harmful and what's the context of this. But one way of looking at this is the chart on the left. We can see that U.S. manufacturing production of durable goods, which include, that could be steel, that could be semiconductors or cars or airplanes. I mean, it's a whole range of things, but generally you can think of as sort of, more advanced manufacturing. And it used to track domestic consumption reasonably well. And that breaks down around the year 2000. And again, we talk about in the book a lot of the things that sort of changed around that period of time that lead to this. But what you can see is that the gray line, which is the actual production, is more or less been flat. It's not completely flat, but it's more or less flat. And it really doesn't track at all the increase in domestic demand. So, the extent that the U.S. economy did increase its demand for manufactured goods pretty substantially over the past 20 years, but not its production, that incremental demand was met entirely by imports. And, one way of looking at this, or thinking about this a different way, is, that means that there must be some, significant change in the financial position of various entities in the U.S. economy. And so you can break down the trade balance essentially into who's doing what. You think about governments, business, households, and what the chart on the right is showing is that crucially, it wasn't actually the government budget deficit that was the big driver of this. The big decline in the black line between sort of the mid 1990s and the mid 2000s, that was driven by, on the one hand, in the sort of second half of the 1990s, you have the U.S. corporate sector, business sector going this big sort of investment binge, which didn't quite work. Some of that may have been justified because of tech advances, but some of it was clearly not. You can think about like Enron and WorldCom, and all those companies ended up going bust as a consequence of overinvestment and overborrowing. And then in the early 2000s, you have a situation where households, I think we all remember the housing debt bubble, that was sort of the offsetting factors. So you had people using homes and borrowing against rising home values as a way to offset stagnant incomes to maintain a standard of living. And it wasn't a situation where there was some massive consumption boom. We talk about this in the book, but essentially what happened was that, consumption actually grew more slowly in the US in this period than it had before, compared to sort of a long-term average. But income growth was so weak that you needed this debt essentially in order to sort of keep things more or less what people were used to. And it wasn't, even then it wasn't enough. But that was also very unstable, and then you had financial crisis. So again, tying this all together, if there had been more spending in the rest of the world, if there'd been a different distribution of income in the rest of the world, there hadn't been these changes that we describe in our book, which would go into more detail, that had, and people had more spending power. Consumers had more spending power globally out of their income. They earned more and had more spending power. Then overall demand for goods and services would have been higher, and incomes would have been higher. There would have been less need for debt, and there would have been more employment. And overall, people both in Europe or in China, in the United States, would have generally been better off. And to understand why we now see these situations where Americans are saying, oh, Chinese are taking advantage of American workers. That's not right. It's that Chinese elites and American elites essentially cooperated against the interests of American workers and Chinese workers, and both suffered, but in different ways. Just as we can look at what's gone on in Europe and say, oh, those crafty Greeks or whatever took advantage of German savers, or alternatively, oh, those awful fascist Germans are imposing this austerity on poor Italians. That's not the right way of thinking about this. The right way of thinking about this is that the sort of the rich elites across European countries came up with a system that worked relatively well for them at the expense of workers in Germany, in Italy, in Greece, and so forth. And that's been bad for the vast majority of people who live there. And so hopefully as we sort of explain how this works, we can get people to change that. But that's ultimately going to be a political process, and it requires changes in sort of the bargaining power of workers, and how they relate to businesses and managers and investors. And so I'll be really interested to hear from Kathy about her actual practical work in that field, as opposed to just my sort of reading about things and playing with data. So thank you.
Okay. So it's a great transition to Kathy. So Kathy, can you, we're looking forward to hearing how this has affected workers in the US and around the world. And so we'll just turn it straight over to you.
Great. Thanks so much. And good morning, good evening to those of us, to folks who are tuning in from Asia. Thanks to NPF. And Matt, it was great to hear your analysis, such an important piece of work. Indeed, over the past decades, the US and global labor movements have been talking about this very model that you've outlined, that it's a problem, that it's a model, a trade model that's been working for corporations, and it has not been one that has asked a fundamental question. Does this trade policy increase wages, which is one of the issues, bargaining power, and does it do any good for the environment? And so the more that we've been raising these questions, they tried to put the labor movement in a box. I think I liked your first slide. I would add some more terms. They would call us, are you anti-trade? Are you anti-globalization? And actually none of that at all. The labor movement absolutely understands that workers are connected through supply chains. We need a functioning global economy that works for workers. But what has happened is that the rules that have shaped the global economy have continued to fail workers. And we've heard some of that analysis from you. And, one of the things that we've been spending time trying to think about is, what is the new model? What are the new policies? And I think the one thing we need to be doing is recentering the objectives of trade policy. Whose interests do they serve? Matt just identified, they serve the interests of elites in countries around the world, whether it's Germany, China. They're not serving the needs of working people in this country or around the world. And they're obviously not serving the need to protect our environment. So we need to fundamentally change the objectives of trade. And so, we need to start asking new questions, not are you free trade, are you protectionist? It is, what are the objectives of our trade policy? And do those trade policies benefit working people so that they can be part of the global economy? They can live lives with dignities. So that's what we have in front of us. And I think it's even more urgent because we're trying to think, how do we rebuild post-pandemic in a way that doesn't go back to the old normal, which wasn't good for working people, based on a neoliberal model that we see has failed over the past 40 years. So those are some of the fundamental questions. How do we shape this? Now, some people might think pie in the sky, right? Worker rights. We've been talking about this since marching in the streets of Seattle. Was there really ever consensus about having worker rights part of our trading system? Well, absolutely there was. If you look at some of the debates post-World War II about the multilateral trading system, Roosevelt and other leaders at the time understood you could not just cut tariffs. That was not all that you needed in a trading system. You needed to address the problems that came with this capitalist model. You needed some rules, some guardrails around worker rights, anti-monopoly provisions. You needed to build models that precisely would not increase trying to pit workers against one another. And back then, there was actually a charter called the Havana Charter that 53 countries signed on to, from the US, the Global South, and Europe. And there was broad agreement that you actually needed worker rights in the multilateral trading system. Now, folks won't be surprised. There was opposition from the business community to having the Havana Charter actually go forward. They didn't want worker rights. These are some of the same debates we've been having today, and we see what has happened. Now, so we know that there has been an understanding for a long time that one of the objectives of trade should be to address this issue around worker rights. Now, in the 1980s, you see a lot of changes happening in the trading system. Here in the US, you see Reagan, you see the PATCO strike, increased attacks on unions, the rise of the neoliberal model. And then you see this global system that is really based on a lot of labor arbitrage, on keeping labor flexible, on creating supply chains that are nimble, where you have a brand based in the US or Western Europe, and they no longer have any connection to their workers. And so, this whole model really gets us to the place that we are today, where we have a trading system that has continued to fail so many workers around the world, and it's not sustainable. And we're seeing real political implications. I want to take a second just to talk about the role of unions. Matt just talked about the need to grow bargaining power, but I always like to assume that people don't necessarily know why unions. What role do unions play in all of this discussion around inequality? If you don't have independent unions, like you do not have in China, that can bargain for the profits that come with increased productivity, then it is very hard to create shared prosperity in the trading system. Bargaining is one of the mechanisms. You have tax policy, you have other mechanisms for giving workers greater income, which is one of the things that we've identified, redistributing the wealth. And in the US, you see the problem that despite 68% of the population, kind of an all-time high, saying, we are positive about unions, we would like a union, we have labor laws that make it incredibly hard. And this is really the story in the majority of the countries around the world, except for Western Europe and some other places where they've created systems where unions are key partners. So in a country like China, when we talk about trade, what they have is the All China Federation of Trade Unions, which is it is not an independent union. Workers cannot bargain. They don't have the right to exercise their right to speak out about worker violations. And that is a real problem. That subsidizes, that creates a low floor in the global economy, which is, attempts to pit workers against workers, when in reality, it really is a frame that is helping corporations. So what about the China policy? I think that's front and center on people's minds. That's been a priority of this administration. We have to be clear that over the past decades, US policy toward China under both Democratic and Republican administrations has failed to ask that very question that I've been putting at the center. Does the policy work for workers? We've seen that since China began opening up in the 80s, how the Chinese model has been not only harmful to workers, but domestic producers as well. We've identified the problems for many years: currency manipulation, intellectual property theft, repressive worker and human rights, which all create an unfair playing field for the US to compete with China. We just cannot compete with a country that is using forced labor or has no independent workers movement, a model where there are state subsidies. We are coming to the table in a very different place. Let me just show you some of the numbers here. So we see the current situation with China and just the impact on jobs. We've got the trade deficit, which continues to rise. And at the same time, this administration that kept saying we're going to get tough, we're going to, bring jobs back to the US, firms continue to invest $14 billion in China, which was a lot more than even in the first year of this administration. We've got massive job loss, most of them in manufacturing, but you also see job loss in electronics and computers. Just in the first 2 years of the Trump administration, you saw 700,000 jobs were lost. And the growing trade deficit, often there are, the states that people think about when they think about trade, but it really has cost jobs across the 50 states, and it has devastated communities of color. If you think of some of the places that have been hard hit by the closing of automobile factories, other manufacturing plants, this has had a huge impact. And obviously, this administration has, continues to say, we've got a new China phase 1 deal, and I want to talk a little bit about that because they said that this deal would really address some of these issues. Unfortunately, as we're seeing, the first phase did not use a new frame. We had the ambassador say that he was not willing to include worker rights even in the first phase of the China agreements, despite the fact the AFL-CIO and many of our allies raise this as a huge concern. They really failed to effectively address the root causes that account for the tension between our two countries, like subsidies, state-owned enterprise, overcapacity in sectors like steel. The phase 1 deal did focus on issues like e-commerce, financial services, intellectual property rights. And as we're seeing the numbers come out, and there's a lot of research even in these past few days showing that China has not lived up to its commitment. But the question again is, who has benefited? So if they're not buying more soybeans as we speak, or the trade imbalance is getting bigger and farmers and workers aren't benefiting, who is benefiting? And I think the answer to that question is clear, that the biggest winner has been Wall Street to date. One of the key issues about the phase one reopening of China was opening up financial services to the US banks. This, of course, has exposed anyone with who's a federal worker and has a thrift savings plan, has exposed workers in this country to what it means to do investment in China. But that has really been the focus of this first phase. It's been a win for Wall Street. It's been not very good for workers, for farmers. And so again, we need to ask, how are we going to reset this trade agreement, this trade relationship? And it is clear that despite everything we have tried to do, hoping when they enter the WTO that it would bring them into a rules-based system, it is very clear that the approach to China and trade has not been very effective. So what about worker rights? Matt mentioned a few of them. When you do not have an independent union, you cannot bargain, remember, for all the increased productivity that has been happening in China. There's a lack of benefits. There's long wages, long hours, wage arrears. We are witnessing the largest use of forced labor since World War II, since the Holocaust, in the Uyghur region of China, which is the Western region. U.S. brands have their supply chains there. So right now, Congress is looking at this issue because we have laws that protect us from importing goods made with forced labor. And so how is it that we are continuing to trade with a country that has forced labor? Precarious health and safety issues, interns, anything to undercut sort of labor. Labor laws are ineffective. One thing that is interesting is when you don't have a way to channel your frustration, what we see time and time again in countries around the world is workers will stand up. And I'll show you the next slide. Is there are ongoing labor disputes. There's wildcat strikes. Some people may remember that image of the Honda workers stopping the supply chain and striking. And as Matt mentioned, there's nearly 2/3 of migrant workers have not signed employment contracts. So this is a subsidy. China is using egregious worker rights violations to really subsidize its economic model, its trade model. We know that when worker rights have been raised, President Trump himself has told Xi Jinping, don't worry about it, about the forced labor issue, about what's happening in Hong Kong. But we believe you cannot fix this trade model if you don't address these issues. And I just like showing, the reality, because I think often people hear, well, when there's not a union, what are workers doing in such a repressive place? And this image really shows you how courageous workers are in a very repressive place. They continue to stand up. They take enormous risks for themselves, and they have wildcat strikes, which means, they're not under the law. A group of workers decide to stop working. Withhold their labor to change the situation, get their wages, make sure they're working in safe working conditions.
So these numbers are the numbers on the circles of the number of strikes in that particular locale?
Correct. And there are just so many labor disputes. So, I always find it's important when we talk about, the closing of civil space in China, the repression of worker rights, that we also show that despite all of that, the courage of people to fight back and make sure they're getting paid, and that if they're going back after COVID, that they have health and safety protections.
And is the Uyghur region, is that the one in the little circle with the one in it in the far far left?
So the Uyghur, yeah, it's all the way to the west, and the Uyghur region has the repression has really escalated since 2017. And one thing most people don't realize, those of us, with our cotton clothes on, that that region produces over 80% of China's cotton, and it's we import more than 30% of our apparel from China. So one of the big conversations, and the AFL-CIO is part of this coalition that has formed, is we believe that U.S. brands should not be locating their supply chains in this region until they can prove Customs and Border Protection that they indeed are not setting up their supply chains in a way that benefits from forced labor. You cannot have a global economy where forced labor is the floor. All workers from Germany to the US to Bangladesh will suffer if you are competing with forced labor. So just to get to some of the recommendations, because I know we want to have time to have a question and answer. What do we need to do? Where to with the sort of idea of changing the trade model? As I mentioned at the beginning, we need completely new trade objectives. We've heard the Biden-Harris campaign talk about, taking a moment to really rethink our objectives so that they're centered on workers' well-being, protecting the environment. We need WTO reform. We don't have enough time to go into that today, but I would just say one of the issues is to include enforceable labor and environmental standards. You let China into the WTO, and there are no standards there that talk about labor and the environment. We need an enforceable labor mechanism in all trade agreements that not only hold governments accountable, which is the old model, but corporations as well. And in the new US, Mexico, Canada trade agreement, the labor movement worked hard to create a new model of an enforceable labor mechanism, which I'm happy to discuss. You need new labor and social protection laws. You can't get it all done with trade policy. Workers need good labor laws that protect them. We need new labor laws in the US. And you need social protection laws that guarantee that all workers have health care and protections, new tax policies. It's so ironic that you have this administration talking about bringing jobs back when what their 2017 tax cut did was create more incentives to offshore. You need transparency in negotiations and expanded participation of workers and stakeholders to help shape these policies. And lastly, we can't do it alone. We must rebuild alliances. We have to rebuild our diplomatic efforts. We cannot think that we are in this zero sum, this framing of actually trade wars I push back on, because that's absolutely not what we want. We need alliances. We need a global economy that functions for workers everywhere. Thank you so much. Yeah.
So we are getting some questions from viewers out there. And so let me get to some of these questions. And I also have some questions, and the president of the MPF, Sunny Efron, has some questions. We'll try to get to as many as we can. First question is from Medihi Shanawaz Jali, who is from Radio Bangladesh. It's kind of a part question, part statement. I just look to have each of you, give your take on this. Are the countries going to protectionism trade policy? Because US, Canada, Europe, and other Western countries are all going back to raising tariffs and abolishing quotas, leading to the trade imbalance and shift of businesses. If it goes on, it would be difficult to attain any global goals, including SDGs, Sustainable Development Goals, and climate changes. So, I mean, how do you respond to both the question and the statement in that? Kathy, maybe you have thoughts on that?
Yeah, absolutely. Again, I think what I tried to frame out is we absolutely need to move beyond tariffs. I think the current model isn't working, where it's just throwing tariffs. That's not going to do anything for working people. It might be a temporary bump in a certain industry. We need to rethink this. I totally agree. You need the Paris agreement to be linked to trade agreements, which I know in Europe they're looking at. And I absolutely don't think this is the moment for protectionist trade policies. What I do think you're hearing is a political pushback around the world to a model of globalization that hasn't worked. And so if we can get a new model that's worker-centered, I think then you talk about SDGs, the Paris Climate Agreement, what actually works for people.
Okay. Yeah, just following up on that, I think, trade itself is not bad. In fact, having bigger markets and more opportunities for businesses to interact globally and workers to sell things across the world, that generally should lead to higher prosperity. That's why sort of the standard economic models say that trade is good. The problem is that if you have other sort of conflating factors, then you can generate problems that were transmitted across the world through trade, and people will think that trade is the underlying source of their own problems when it's really something else that's causing that. And so, for example, if Chinese environmental laws and labor laws are such that people in China are harmed and have less money to buy goods and services made in the rest of the world, that will ultimately redound to lower incomes in the US and in Europe and so forth. And then people in those countries might reasonably think that China is to blame and try to punish China when that's not really right, because Chinese people are also suffering. And so it really helped, reframing that conversation and perspective, I think, is really key, because otherwise, the protectionist impulse in and of itself is not going to actually solve these underlying problems. And the underlying problem is you have an inappropriate distribution of income globally, a big change in the distribution of income globally that has suppressed consumption relative to production, and that's led to these other problems.
Matt, I just from your book, one of the statements from the book is the surprise is that Americans have tolerated the open system for as long as they have. I know this is a fairly big question, but I mean, why have Americans tolerated the system as it is for as long as they have?
So I think there are a couple of reasons. One, I mean, first of all, it is a surprise, I guess, because and you look at the sort of costs that have been imposed on a lot of Americans, it's either shown up in forms of lower employment or lower incomes or higher debt. And so I think the explanation is sort of twofold, which is that, one, for a very long time, basically since the early 1980s, interest rates have fallen so much that increases in debt were relatively affordable for a lot of people. And so that wasn't necessarily a problem for a lot of people to think, oh, we're borrowing more, but the cost of the debt service, and I'm talking about not government necessarily, but, in households, mortgage rates and so forth. And so that kind of phenomenon, I think, made it relatively tolerable, at least until you get to, 2006, 2007, when there clearly was a limit that was hit. So there was a long stretch of time when I think that helped. I think the other thing too, and this is an area that's sort of outside of my own, but I sense it's in sort of an ideological consensus on this, that people just were told repeatedly that this is something, that this is how it's supposed to work. If it's not working out for you, that's your problem. This is, and I think that also contributed to these things. But I mean, as I said, it is a surprise that in a democracy, and the context of that statement is that, going back to the very beginning with Hobson, that, well, there are a lot of important differences in the world now and the world in the late 19th century. In an economic, perspective, the U.S. effectively plays the role of a colonial subject state for a lot of the major trade surplus countries, such as Germany, China, Japan, and so forth. And that, obviously, I'm not saying the U.S. is a colonial subject state. I'm not saying that it's equivalent to what the British did in India or anything like that. But there is a perspective from which you can see some similarities, and it's interesting that was done voluntarily in a democratic, independent country. And so that really is the question.
Okay, Kathy, why do you think Americans have tolerated the current system as they have for as long as they have?
Well, I mean, I would push back a little bit. I mean, I think there has been critique, right? I mean, I think
Right.
you saw huge, you've seen huge protests against the free trade agreement of the Americas, against a lot of these trade agreements. I think workers have questioned why, this agreement is going to be good for them. They got trade adjustment assistance for a few months, as if that was going to replace jobs that were left. And so I don't think everyone has just agreed to this, but I agree with some of what Matt has said. It's also this mentality that was sold by the elite that, there's something wrong with you, right? Or, it's something that's going on. It's you, workers against workers. I do want to just say one point about the investment from other countries. We did a report about increased investment from Europe to our South. Because our South looks really attractive these days, right? You have no unionization, or very low unionization, right to work laws. The governors will give you big tax breaks, keep workers' wages low. And so it's this model that has been built, and that we're supposed to say, this is good for working people, keep them flexible. And so I think, it's a huge problem with the way the model's been built. But I would say people have been criticizing this and pushing back. And I think we're getting to a tipping point now.
Okay. Sunny Efron, who's the president of NPF, has joined our call here. She was a longtime foreign correspondent for the Los Angeles Times in Tokyo, so she understands these issues pretty well. And so, Sunny, you have some questions?
Well, first of all, thank you both so much. This is just a terrific discussion. I wanted to turn it toward the policy choices that the American public face in this election and going forward. First, let me ask a contrarian question, which is, should U.S. trade policies specifically have the goal of improving the lives of workers that do not have a college education? Or should those goals primarily be pursued through other means, assuming that we agree that it's a worthy goal? Like, for example, more direct aid to workers. Kathy, you mentioned the trade adjustment assistance, or subsidized healthcare, or no interest educational loans, or Andrew Yang's minimum guaranteed income. My question is trade policy the most effective way to address the legitimate concerns that I think you both are flagging?
You want me to?
Yeah, why don't
Please.
you go ahead, Kathy? Yeah.
As I tried to say in my last slide, I actually think you cannot put it all on trade policy. And that's always been a problem, that, in every political cycle we get into, that it's all about trade. And it's actually about broader failures domestically, right? It's about our economic policies that have failed working people in this country, our labor law. We need the PRO Act we're pushing for labor law reform. We think that would make a huge difference to give greater bargaining power. The healthcare crisis in this country, right? So all of those pieces come together. I would say trade, what is important about trade is what people can see as the sort of global framing. And I do think that you need both. It's not an either or question. I actually think you need to have a trade policy that correctly frames rules of the global economy, and you need effective domestic policies that address the well-being of working people.
Yeah, I actually might push back in a little more. I'm not sure that trade policy in and of itself does very much one way or the other. I mean, the biggest trade relationships the U.S. has are with Europe, outside of NAFTA, are with Europe and China, and we don't have any formal trade agreement with either country. I mean, there's the WTO, but that's about it. And one of the sort of underlying themes of our book is that really what we think of as domestic policy often has really profound international impacts, regardless of whether anyone thinks of it that way. And so I absolutely think that if the goal is to improve living standards of people in your own country, then you should focus on doing that directly. I think that the potential trade-off, and the U.S. might be in a better position to handle that trade-off than other countries, but that doing so without having other countries change their own domestic policies is going to lead to an increase in debt. And so, the U.S. government could just borrow and spend a lot more to improve living standards for, Americans who don't have a high school education or what have you. And that would work for those people in terms of, increasing spending and incomes, but that would be offset somewhere with some higher debt somewhere in the system. And if you want to avoid that, then you need to have higher spending in the rest of the world to offset that. And so that, is trade policy the way to get that? I don't know. I mean, we don't really have a lot of sort of concrete solutions for what the U.S. can do, because it's not really, in some ways, it's not specifically U.S. problem. I mean, there is underspending in the U.S., but in many ways, it's really other countries in the rest of the world that really need to change their own domestic political economy. And so, that's really a question for, diplomats that's above my level of expertise.
So I have one more that perhaps is too specific for you, Matthew, but which specific, understanding that there are limitations to what trade policy can do, can you recap which specific trade and investment policies you think would specifically help workers without a college degree? And I'm specifically asking that because of what's going on in the swing states, and because of what many commentators have identified as the politics of grievance and resentment, and the left behind and the losers. So what, granted it won't do everything, what specifically would work in your view?
Well, I think one thing that in general, whether you count this as trade policy is a different question, but I think that the extent that the dollar generally tends to be overvalued. I remember interviewing someone who used to be at the Federal Reserve on International. He said the dollar generally tends to be between roughly correctly valued and egregiously overvalued. And when the dollar is expensive, then essentially what that means is that things that are made in the United States are not going to be able to be sold abroad, and also means that things that are made abroad can be very competitive compared to things that are made in the United States. And that, you know, I don't think it's necessarily, you know, again, is that trade policy or is that sort of a financial regulation policy? But that I think is something that if you had a lower dollar, then a lot of that spare manufacturing capacity that exists in the United States, and that existed even before the coronavirus, could potentially be deployed to satisfy, you know, U.S. domestic needs and needs of people in the rest of the world, and that might help.
And I would just jump in. I mean, I put this in my slide, but we have to reverse the tax policy that happened in 2017. I mean, I think that that is, you know, really key. It created a lot of incentives to offshore, and we're continuing to see a lot of jobs leave the United States. I actually think is a good policy we've heard in the debate is to take a pause on trade policy. That would be good to really rethink, how do you connect? What are the needs that we have globally? How are our supply chains? We've got our PPE. We can't even produce PPE to keep people safe here. A pause, I think, would be really helpful to try to make these connections. What are the offshoring tax penalties that we should have? What kind of tax policies to bring things home closer here? The enforceable labor mechanisms so that corporations can't go low road when they go to another country. Europeans who come to the South can't be union busting, can't go low road. So I think a lot of those pieces would be welcome and would bring some real change.
So we have just a few more minutes. If there are those of you who have a question, raise your hand. We'd like to get some, love to get some audio questions. I do have a question from Rizwanul Islam from North South University in Bangladesh. It's kind of touching on what Sunny was asking, but in a slightly different way. If the governments did enough to address the problems of people who are left in the rear by trade liberalization measures, such as creating new jobs or tax measures, could trade wars be less of class wars? I mean, if they address the domestic issues, then, you know, could there be aggressive trade policy or different trade policy that doesn't have the same impact on class, on the working class? Either of you have a thought to that?
So, I mean, the short answer is yes, but then that does come at a potential cost, which is, as I said before, you have an increase in debt. So if the government takes the burden of the debt on itself, then that, you know, can work if you're a country like the United States that is relatively, you know, flexible in its ability to issue debt that people want to buy. If it's not, if the government budget deficit though is too tight, then you end up having households borrowing to do that, or you have government, or if you're in a country where the government has less flexibility, like Spain, for example, you know, then that's not a sustainable solution. So if you look at Spain, I think it's a really interesting case, and we spend a fair amount of time talking about this in the book. You know, basically between sort of 95 and 2008, this incredible increase in living standards of productivity. They got a lot of direct investment from, you know, various companies in France and Germany and in the US and manufacturing there. Things are great. They build this world-class high-speed rail system, but and it's a relatively egalitarian society at that time. The problem is that because of the relationships that they have with, you know, particularly Germany, where you see really going the opposite direction with significant deunionization, significant cuts in public infrastructure investment, that the Spanish economy is only able to, you know, maintain the way it is by having massive increases in household debt. Government debt is actually quite low in Spain during this period, but household debt just goes through the roof. And, you know, that was not sustainable. And then you had this massive financial crisis, and the Spanish government tried to step in briefly to, you know, offset the change in household financial positions, but then that quickly was cut off from them as an option. And now Spaniards are still poorer than they were, you know, in 2006. And so that doesn't, so there clearly is a challenge, and Spain, unlike the US, actually did a good job maintaining its manufacturing employment and employing people who weren't, you know, super educated necessarily, but in good, well-paying jobs. But it wasn't a sustainable strategy for them because of the implications of debt and because there wasn't really a symmetric response elsewhere in the world, particularly in Germany. And so I don't think in and of itself, the idea that, oh, we can just sort of ignore underspending in the rest of the world, everything will be fine. Maybe if you're the United States, you can get away with that, but that's not globally going to be a sufficient solution.
Kathy, any thoughts from you?
Yeah, I mean, I would just jump in. I think that Look, we're in an incredibly important moment, right? This crisis is opening up. It's really exposing the fissures in the global economy. It used to be I'd be the lone voice on a panel talking about the elite versus workers. Now this is the sort of the conversation. So it's really important to see that we're in a moment of change. I would say that I think that as we think about rebuilding, about new trade models, we need to think about what a new social contract looks like between governments and workers. I mean, that's going to be key. You know, what is it that workers are going to need to have good jobs, to have now healthcare protections, both in the workplace and in their homes? It's a time to have all of these debates. I think that, you know, I hate to keep talking about tax policy, but the models that have been built have allowed so many multinational corporations to get away with not paying taxes, which erodes the ability of so many countries to have the funds necessary to build social protection systems and the things that are critical to workers. And so looking at that, changing how that trade policy works, how the investment policy is structured, what kind of regulation we need, so that it's in service to, you know, governments being able to provide for people. But it's a great time to be thinking about what does a new social contract look like? That should be what we're talking about, whether it's through trade policy, social protection policy, new labor laws. We are in a moment of change. The neoliberal model for 40 years has been shown to have created a lot of this crisis. What's the new model? And I think it's a great time to be thinking about it.
Okay, so I have a fairly specific question here, from Jeff Wheeler of USAID in Washington. What do you think of labor conditionality in trade preference programs? Does it work, and how does it need to be reformed? And if you could also give us a definition of what labor conditionality means.
I think that was
Kathy,
for me, Jeff Wheeler. So unless Matt, you want to jump in on it?
Oh, you can go that first on that one.
So labor conditionality. In our trade laws, we have commitments. We have labor chapters. This was a huge debate in the Trans-Pacific Partnership and NAFTA and the recent US, Mexico, Canada agreements. That a country needs to commit. If you are our trading partner, you have to commit to upholding a certain set of ILO standards, International Labor Organization standards. For years, these have been incredibly ineffective. You could kill trade unionists in Colombia. There was a case that we had for 8 years about worker rights in Guatemala, and workers lost. So for many years, labor conditionality has been weak and ineffective. The new model that was just passed in the USMCA tries to move us to a new place, which basically says that if you are a corporation, not just the government, but if you are a corporation that violates these worker rights, because it's usually the corporation, you could eventually have your goods blocked at the border. There is a serious consequence, not just a small fine so that you continue business as usual, but that your goods cannot come into the United States. And that's really the labor movement's position is, if you're going to really address these imbalances, address the ongoing worker rights violations, whether forced labor of the Uyghurs, those goods should be blocked until the worker rights violations are addressed. And so that's some of the way that we're trying to think differently about effective models of labor conditionality.
Okay, I think I have one final question here, and we're going to have to wrap it up here fairly soon. But Matt, I was hoping, your book has a good sense of history in it, and you have a few chapters that kind of take people back to the 1800s. I was hoping you could just give our viewers kind of the big picture overview of kind of the globalization trend lines over time. I mean, how much of trade, how much global trade was in the end of the 1800s, and then it went down, and then it's come back up again. Can you just maybe give us the broad brush of what today's situation looks like compared with previous decades?
Sure. So basically, trade, the biggest single constraint on trade is that there are technological limits on moving things over long distances. And so, both in terms of communications technology and transportation technology. So if you're going back to the early 1800s, trade is quite small as relative to the global economy. And if you are going to be trading something, it's going to be something you really can't have at home. So the sort of classical example is, English people importing wine from Portugal because they couldn't really make wine in England that tasted any good. And so that was that was how trade worked for a long time. And you saw that even basically into the into the 20th century that trading things, even though communications technology improved pretty dramatically, that it was still very expensive and slow to actually move things over long distances, really until actually the 1980s. And so that's a big thing. Political limits are a big thing. So the fact that countries were often at war with each other until really after the Napoleonic Wars was also a big inhibitor. I mean, again, sort of a little historical thing. The reason why the English-Portuguese wine trade became such a big deal was because England English consumers used to get their wine from France, but then they kept fighting the French, and so that was cut off. So where else are you gonna get wine from? You got it from Portugal. So that was sort of what trade was like. And now it's very different now because it's so cheap, relatively speaking, to move things across long distances. You have these massive container ships, so the marginal cost of putting something in a container and sending it somewhere is close to zero, unless it's a car, and that's why car assemblies are different. But like a lot of those things, it's quite cheap, especially when a lot of the higher value goods are very small, microchips or whatever. And so now it's a situation where you can have all sorts of goods trades are spread out all over the world, basically among, whether it's because you have sort of specific competitiveness factors, or it's a function of the fact that workers are underpaid in certain places, so you want to obviously move your production where you can get relatively higher profitability in your operations. That sort of relates to the fact that trade used to be really much in either raw commodities or finished goods, and now most of it's in components and parts, assembling it. That having been said, if you sort of zoom out a little bit, a lot of what we think of as international trade, the reason why trade as a share of GDP is very high, is because you have trade sort of within these blocks, this sort of broader, value chain. So like within Europe, a lot of international trade, for example, is within Europe. And so if you think of Europe as a unified economy, for example, then like a lot of international trade sort of disappears. And maybe you should, because Europe as a whole is comparable in sort of size and shape to the United States. And so we don't think of, if you counted each US state as a country, international trade would look very different in the US than it does in Europe. So like Germany, for example, Austria, Belgium, it's very trade intensive, but it's mostly with each other. In Asia, it's a little different, but it's still similar, where a lot of trade is sort of within these sort of networks, Japan, China, Korea, Taiwan, Thailand, Malaysia, so forth. So, and then you can, if you sort of zoom out and think about these big blocks in the US, for example, US, Canada, Mexico, if you think about those big blocks, trade between them is still significant, but as a share of the global economy, it's not nearly as big as sort of overall trade as a share of the global economy. And in fact, if you look at trade as a share of GDP within these major blocks, it's not 60% of GDP, which is what the world trade is. It's more like 10 to 20. And so I think when we talk about trade, it is important, but it's also in some ways sort of a residual of what people are producing and consuming at home within a major sort of continent-sized economy. And that in some ways has not really changed. It's become easier to trade across countries and because of technological improvements and communication improvements. And there's obviously the end of the Cold War led to a massive increase in market size and where you could find people to produce things. But in some ways, things did not change as much as you might think.